Did the US Treasury market just glitch? Or is something big in the financial system beginning to break, with signs of disruption first showing up in treasuries? Typically, when there's trouble brewing in the financial system, there are signs, there are little cracks that show up in the US Treasury market, giving a little signal to the market that something big is about to break. This happened prior to the financial crisis. It happened prior to 2020 during the September 2019 repo market meltdown, and it's possible it's beginning to happen again. On Monday, September 18th, we saw the yield on the 2-year government treasury reach almost 5.5% before it came crashing all the way back down. Number one, this is an unusual move. Number two, it is unusually large. Number three, whenever you do see a move this large, you usually don't see it return immediately back down to where it was before. Now, I'm gonna show you why the narrative that this was a glitch is partly true. Right now, what we're looking at is the yield on the 2-year treasury, where each candlestick represents 1 day's price action. But we can change the time interval so that each candlestick represents 5 minutes. And here you can see the massive spike with a drop and then some trading action and then another drop again, right back down to where it was before. Now here we've tightened up the chart even more so that each candlestick represents just 1 minute. And at first glance, it might look like the unusual trading is completely gone. But if we zoom in right here, you can sort of see one tick mark up at 5.49%. That right there was the misprint. No trading actually happened there. However, this is what I am suspicious of, because this right here wasn't just one single tick mark with a misprint. This was happening over the course of like 30 minutes. Now, it's possible that that also was really actually just a glitch and that there was no trading at those abnormal prices, especially considering it came right back down to normal after that in the same trading range it was at before. But what's odd to me is we got a little bit of a spike in the 6-month, a bigger spike in the 1 year. We also got a big spike in the 10-year and in the 20-year and in the 30-year. Those were certainly not glitches. Those were just abnormal trading going on. Definitely not as large as what the glitch made it look like, but still a disruption and not a price move that you tend to see out of the most liquid and the safest bedrock of the entire global financial system. Now, you might be suspicious just by the very fact that there can be glitches and there can be misprints, but they're actually nothing new and they happen fairly regularly. In fact, if we take a look at the chart for the 1-year US government treasury yield, we see that the exact same thing happened on July 20th, with the misprint making it look like the yield traded all the way up to 6% before crashing right back down, which of course did not actually happen. But you'll notice that on July 20th, no similar move happened on the 2-year, the 10-year, the 20, or the 30, which means that while this time there was certainly just a glitch, there was also something else happening at the same time. So let's take a look at a couple of reasons, because as of the time of this recording, nothing significant has broken in the financial system. There are a couple things in the banking system that I'm looking at right now that within the next few days, maybe the next few weeks, could come out and say, hey, there's major trouble here. The first one comes from just a couple of weeks ago. The Federal Reserve itself was sounding the alarm on hedge funds gaming US treasuries, saying that, hey, there could be possible disruptions in US treasuries due to this hedge fund trading strategy. Perfect timing. The Federal Reserve warns, hey, there's this new trading strategy that's come back that has happened before and has caused issues with the trading in the treasuries market before. And it's happening again. And hey, there could be disruptions in the treasury market. And look at that, just a couple of weeks later, what do you know? Disruptions in the US treasury market. The trading strategy they're referring to is the basis trade. It's a type of relative value strategy where the fund will sell a futures contract, buy a treasury with repo funding. If that sounds like Greek, don't worry. Very simply, what they're doing is they're borrowing for cheap, buying something that pays just a tad bit more, and then once it all matures, they just pay everything back and they're good to go to repeat the trade. This works very good in normal markets, but if something happens and everybody's forced to unwind that trade before letting it mature, that's when you get the disruption. So that's culprit number one. It could be hedge funds and large institutions with the basis trade maybe forced to unwind a little bit. But first, a word from today's sponsor, Silver Bullion in Singapore. They have a revolutionary revolutionary peer-to-peer bullion secured loan program. This enables you to put your precious metals to work by taking out a loan against your gold or silver. Now, because your loan is collateralized by your metal, you get some crazy advantages. Essentially, you get to set your own terms for the loan. First, you get to choose the amount you want to borrow. You can choose which currency you'd like to take the loan out in, like Singapore dollars or the euro or US dollars. You can choose your loan duration, anywhere from 1 month to 2 years. And you can even choose the interest rate that you want to borrow at. Now, the best part is that as a borrower, at no time do you lose any of the full legal ownership of your precious metals. This peer-to-peer secured loan program comes along with many other benefits of storing metal in their Star Storage program. Again, you have full legal ownership always. The vault tests your metals to make sure that they know exactly what is there and where it is. The jurisdiction in Singapore, which is one of my favorite benefits considering Singapore is my favorite country on earth to store precious metals in because they have the highest degree of economic freedom of any nation on earth. They also have industry-leading insurance on top of what is required for things even like mysterious disappearance coverage. Now, there's obviously a lot more to this, so I highly recommend clicking on the link in the description below, filling out the form so you can contact their team to learn more about this amazing program. Link is in the description. Ahead of time, but there's other problems brewing in the financial system as well. One of them is that banks are having to increase their borrowing as a result of their reserves dwindling. Banks increased their borrowing in August by 9% as a result of deposit outflows. If you've looked at your bank account statement recently, you may have noticed that you're getting 0 or 0.1% interest. Meanwhile, you could go get something like a money market fund with a portion of your cash and get paid 5 to 5.5%. Many investors have noticed the exact same thing, have taken their excess cash out of their bank accounts to put it into a money market so that they're at least getting compensated for the risk of having their cash with a middleman. Now, I certainly don't suggest doing that with all of your funds. However, I'm currently putting together a course on cash management that gives you the exact playbook on how to take your cash savings and divide it up perfectly so that you get the extra return that will be inflation while minimizing that risk of bank failure, bank bail-ins, banks freezing or seizing your assets, and maintaining liquidity. The course is launching very soon, and if you'd like access to that, join Heresy Financial University. Link is in the description below. Now, reserves right now at banks are not unnaturally low. As of July, we were still sitting comfortably above $3 trillion. Bank reserves have been above this level ever since the money printing started in 2020. However, recently the Federal Reserve has been looking at the reverse repo facility as basically a proxy for additional bank reserves. Somebody at the Fed wrote a whole paper about it saying basically, hey, reserves are plentiful because we have bank reserves, but we also have the reverse repo facility. And just 4 months ago, that total cumulative number was well over $5 trillion. Because back in May, the reverse repo facility had about $2.3 trillion in it, and it had been that way for over a year. But increased government borrowing has made government treasury debt more attractive because the rates are more than what you can get paid to leave your cash in the reverse repo facility, which means that cash is now draining out of the reverse repo facility. Almost $1 trillion has drained out of the reverse repo facility in the last 6 months, bringing the total to just under 1.5 trillion. So while banks are not in trouble yet with the amount of reserves that they have, when you count reserves plus the reverse repo facility, you can see the trend is getting there quickly. An additional risk that's building pressure in the financial system right now is that hedge funds have recently flipped on the dollar. They have just turned bullish on the dollar for the first time since March. This is in anticipation that the Federal Reserve will be a little bit more hawkish with interest rates and their language that they use than the market had anticipated up until this point. So speculators have been bearish on the dollar, deeply bearish over the last year or so. And now this is the first time they've flipped to a net bullish position since March. That kind of flip can absolutely have an impact on treasury markets. So if you're keeping track, we've got 2 scores for hedge funds and 1 score for banks, but don't worry, the game's not up yet because this next risk we're going to be looking at is banks. The deposit flight from commercial banks continues. Not only has it been almost 30 years since the last time deposit flows for commercial banks were negative. Since the Fed began collecting this data, it has never been as deeply negative as it is right now. Like we discussed earlier, deposits are leaving banks very quickly, which makes sense. You put your money in a bank account, accept the risk from the bank and the risk from whatever the bank does with your money, and then they don't even pay you, which makes sense because with a bank, number one, you give them your money, and then they take your money and they give you risk with no return. So you're taking on the risk of the bank failing, but you're also taking on the risk of whatever they invest your money in failing. And they're not even giving you any of the return on that, maybe 0.1%. So deposits are flooding out of banks like crazy, which means as a result, banks are having to tighten their standards for lending. As we've talked about in past videos, when banks on net are tightening their lending standards, that is a key contributor to a recession happening soon because it makes it harder to get funding. It means less people and institutions have access to that funding, which means that servicing existing debt becomes harder and income available for other things goes down. And every time this key indicator of banks tightening their lending standards gets above 50, we see a recession happen right around the exact same time. As a result of this, the money supply is still contracting. Not only is it contracting at a faster rate right now than it has since the Great Depression, but it's also the first time since the Great Depression that it has actually contracted at all. So to put it all together, we see risks building in the financial system everywhere you look. One or all of these, or maybe none of these, could have been what contributed to the odd trading that happened in treasuries. We know that past financial crises have been precipitated by unusual moves in the treasury markets. So this is definitely a red flag, though no guarantee that anything is about to happen. But even if nothing is imminent, nothing is right around the corner, and there's no financial crisis waiting for us that the Federal Reserve is going to have to deal with and lower rates and print money and what yield curve control and everything like that. This was, let's say it's just an anomaly. We still have to contend with the long-term risks that are just facts. No guessing, no speculation, just unavoidable problems that we're rushing headlong to into the long-term future. The United States government just passed $33 trillion for its national debt for the first time in human history. $33 trillion. And so in honor of reaching $33 trillion for the first time in US history, I took the liberty of calculating, number one, how fast does the United States national debt double? And number two, based on that doubling rate, how soon will we reach $1 quadrillion? All right, so starting in 1993, the US national debt was around $4.5 trillion. So fast forward 10 years from there to 2003, and we are a little bit behind here at $7 trillion. So let's get to our double of $8.5 trillion, and we're at 2006. Doubling from there to 16 trillion, we are back on track at 2013. So the average of the previous 20 years, still at doubling every 10 years. Fast forward 10 years from 2013, and we are right on track again at $33 trillion, which means that in 2043, we would be at 128 trillion. 2053, we get to 256 trillion. 2063, we get to 512 trillion. And by 2073, we'd finally get to 1 quadrillion and beyond. I'm sure the founding fathers never in their right mind could even imagine the national debt getting to $1 billion, let alone $1 trillion, let alone $33 trillion. And just like that, today, many people cannot imagine what life would be like if the national debt were to reach 1 quadrillion. So my parting question to you is, do you think that by 2073, maybe earlier, maybe later, that the United States will ever get to actually $1 quadrillion in US national debt? Or do you think something will happen that will prevent that? And finally, for everybody who wants to protect your investments, your cash, your hard-earned money from inflation, from deflation, from crashes, still be exposed to upside of markets, be allocated correctly, but hedge yourself so that you can take advantage and make money off of those crashes. It's time to sign up for Heresy Financial University, the best source of financial education around. Link is in the description below. As always, thanks so much for watching. Have a great day.